Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Madeline in the YFP Facebook group, and she asks, "Hello, YFP team. About a year ago, we moved to Ohio from Michigan. Obviously, had to find a new job. Currently, I have several retirement accounts from both institutions. I'm wondering if it would be best to roll these accounts over into one account. I've heard something about fees involved when leaving them with a prior employer, although I'm not quite sure why this would be, or if there are other better options. Is there a time frame that this has to be done within?" She also adds that with the old employer, she currently has 457B, 403B, 401A, and with new employer has a 403B, and she thinks that's it. Tim Baker, what are your thoughts?
Yeah, so I know we've gone through this in past episodes, but we can kind of give the down and dirty answers. First off, Madeline, thanks for the question. There really is no deadline for any of this stuff. The only time that there would be a deadline is if the 401k or some type of retirement account that you have is really small. Sometimes the plan automatically kind of ejects those smaller accounts and they'll send you a check. And unless you deposit that check into something like a rollover IRA, then you'd be taxed and penalized on that. That's the only deadline. Everything else is really not time bound at all. So the four main avenues that you could go down is cash it out. So cash it out is typically where you just take, you say, hey, I want my money. I want to spend it today and go forth. Obviously, typically not advisable because unless you're 59 and a half years old, you're going to take a 10% penalty and pay the taxes on it. So we typically don't want to do that unless, you're in dire straits. The next option is to do nothing and basically keep it where it's at. To your point, yes, sometimes when you are coded as an inactive participant versus an active participant where you're at the current employer, you will sometimes be charged additional fees, which often are not very transparent to you. So that can be a thing. Sometimes though, if the plan is great, meaning low cost, a broad spectrum of investments, the investments are doing well, sometimes it does make sense to keep it there and do nothing. The third thing that you could do is transfer it over to your current employer's plan. So the IRS has a good table, and we could put a link of that into the show notes that has like a rollover chart. Mm-hmm. The 457, 403B, 401A would roll into the 403B. So we're kind of going pre-tax to pre-tax. So you could do that if the 403B is decent. We typically look at, again, things like fees, investment selection, et cetera. You could do a transfer such as that. Or the last thing, and typically the most common thing to do, is to roll it over to an IRA. Now, what I typically tell clients is that most financial planners are going to say, roll it over, no question. And the reason that they say that is it's more of a function of how much they get paid, the advisor. Most financial planners are going to get paid based on the amount of assets that they're managing. So if you're sitting on $100,000 in an old 403B, they're saying, okay, if I charge you 1% on that, that's $1,000 that I can add to my fee.
Right.
So although the advice is typically sound, it is not without conflict of interest. Typically, if you take away advisor fees and things like that, the IRA environment, the IRA account will be more efficient than most 401ks, 403bs, et cetera. And it's a question of fees. So in a 401k, a 403b, there's typically, third-party fees like administrative fees and bookkeeping fees and things like that again are not a line item on your account statement. It's just what basically the plan custodian takes to administer the plan. So I often mention my wife at her previous employer, it was like 0.7%. And then if you add up what she's paying to the individual funds that she's actually invested in, the mutual funds, which was like 0.05%, that's 0.75% all in. So on a $100,000 portfolio, that's $750 per year. If we were to roll it into her IRA at YFP, what I'm managing for her, it's just 0.05%, which is $50 per year on a $100,000 portfolio. So those are the things that we're weighing. So with the rollover, again, the advice is typically sound because the IRAs are going to be more efficient. From a price perspective, you typically have a lot more investment selection. So I typically say with the 401k, 403b, TSP, you got to play with the toys in the sandbox, which are 20 different, 30 different mutual funds. Whereas in the IRA, you can buy just about anything that you want. It's typically cheaper, much more investment selection, et cetera. The things that you don't have is you can't take loans, which may or may not be a good thing, and some of the flexibility there. So just to recap, Madeline, you could cash it out, you could do nothing, you could transfer it to your current employer's 403b, or you could roll it over into an IRA for you to manage yourself or with the help of a financial planner.
Great stuff, Tim. And Madeline, thank you for your question to the YFP Facebook group. And for those listening, if you're not yet a part of the YFP Facebook group, we'd love to have you. Just head on over to facebook.com, search for the Your Financial Pharmacist Facebook group. You'll see us, a large community of pharmacists all across the country, helping one another on the path towards achieving financial freedom. Some great discussions going on there right now about goals in 2021, resuming student loan payments, and much more. So I hope you'll join us. And if you have a question that you'd like to have featured on an upcoming Ask YFP CFP episode of the Your Financial Pharmacist podcast, please shoot us an email at info@yourfinancialpharmacist.com, or go ahead and record your question by going to yourfinancialpharmacist.com/ask YFP. Have a great rest of your week.